Hey guys, it's JP Invests here, and today I'm going to be introducing myself and kind of telling you a little bit about myself and getting into a couple real estate stocks that I think are a really good buy and have a great upside potential in the future. So, a little bit about me. I am a 21-year-old college student. I am studying accounting, and I just have a big passion for mostly just the stock market and making money and trying to beat the market. I've done pretty well in the past 3 years that I've been able to invest into the stock market. On the all time, I'm up 32% or 30, almost 33. On the 1 year, I'm up about 20%. And then if we look in that August, we are almost 50. We are 46% up this summer. That was during the little craze this summer before the market dumped off a little bit. And we've been fighting back. We've had a pretty good 1 week up 8% on the month. We're not doing great, not doing bad, but on the 3 month is where we got kind of killed after that August pullback. The interest rates on the bonds went up a little bit more, but those are starting to pull back a little bit more on the 10-year Treasury bond. What the yield is, it's been pulling back a little bit. So now the stocks and the bond ETFs are able to push up a bit in price because people aren't trying to get new bonds that are higher rates. Okay, so getting into the four stocks that I think are great investments right now. The first is Crown Castle Inc. So what Crown Castle Inc. is they are a real estate group, and they own the property under the cell phone towers, the 5G small cells, and they own about, I think, 85,000 miles of fiber optic line throughout the country. They rent this out through Verizon, T-Mobile, and companies like that need the fiber optic ran to them, and they need the land for the cell towers. They have all that, so they just rent it from them, and they collect the money, and then they redistribute it to either CapEx, which is growing to more cell towers, trying to get more revenue, growing bigger, or they pay it back through their great dividend. Their dividend right now is a hefty 6.48%. Means you're going to be getting a 6.8% yield per year, and they pay quarterly. So you'll get that cut divided by 4. You'll get that 4 times a year, and that's per share. So if you looked at mine, I own 16.8 shares with the average cost of $96.69. So I'm right at break even with this stock price. If you go down a little bit, I think I have a old dividend. So they pay you a dividend. It's $1.57 per share. So it's not a bad little dividend per quarter. It allows you to grow at 6 point whatever percent guaranteed every year, unless they did cut that dividend. But I don't see any future of them cutting the dividend. That's not why their stock price is down on the year. That's not why they're down 30%. They're down 30% because of their business model being a high leveraged business model, where they take out debt to go build more or buy more land, and then they go rent out that land to pay for the loans that they have. They also have been hit with the merger of T-Mobile and Sprint. That they're going to be cutting some of those contracts because they're not going to need double contracts for that. They'll just be using one contract. So they'll be losing some revenue in the short term, but the CEO has reassured that we will be all good, and hopefully I think end of 2024 to 2025 is when we should be reaccelerating to the growth what they priorly had. So that's Crown Castle. That is my second most bought real estate. And the thing about real estate is they have to pay 90% of their their profits. So it kind of forces them to have to pay out. It's hard for them to grow. So sometimes under these harder economic struggles, like the higher interest rates, which all REITs are highly leveraged, or most, I shouldn't say all, which they're going to have to be paying more in interest, which is just going to hurt their profitability, which could make them cut their dividend, which is the main reason most people invest into a lot of these real estate companies. Another one is SLG. So what SLG is they are a New York property REIT. So they own Class A buildings in New York, which the Class A is very important. I wouldn't just be buying any real estate offices right now. That's because of COVID, pushing a lot of people online, making it so it's like you don't have to go to work, or it's like hybrid, stuff like that. So a lot of these companies are cutting their leases, or just like cutting down on how many leases they have. So if you own a lot of Class B and not as nice buildings, they might not go with your building. But in New York, they've seen the lease occupancy going and increasing. They also sold one of their buildings for collateralization so that they can just pay off their loans. They don't have any big loans coming up for a couple of years. And the management team has talked about how they would like to, they're very dividend focused, so they're not going to be cutting the dividend. They would rather sell assets, which it's not the best thing to sell underlying assets because those are what make you the money. But if they can need to do it in this time when the interest rates are at a 20-year high, I think that's understandable. Looking at a little closer on the year, they've had a bumpy year, but overall their stock price has just been down a lot, and that is because of the companies not coming back, and that was a little bit of a problem before this year, but it's been recovering a lot more because all these companies are seeing how much less productive people really are. Looking at the dividend for this, it's a 10.13%. That is crazy. Also, another thing about this, it pays a monthly dividend. So I'm getting an $8.40 dividend per month in this. But I also do have a pretty hefty investment. Well, not pretty hefty. I guess it's only $1,000, but it's a pretty sizable investment. I would say this is a little bit more risky than CCI and the other two that we're going to be talking about, just because of the it's higher leveraged, and it's just in the specific office REITs that are at a little bit higher risk, just because they are specifically offices, not like one of these companies I'll be talking about later, which it is health science buildings, which are at a little bit higher demand. And if you looked right here, that is like one dividend that I do have coming in. It is just monthly. It's pretty much every 15th of the month I get $8.40, and I'm going to be starting to reinvest that again. I didn't right away, just because of the sheer amount I had, and I thought I had enough, and the price shot up a lot, but it's pulled back a little bit recently, so I'm going to be reinvesting it for the next couple months. But we'll be reevaluating it once it gets into like the $45 range. I think that's where I'm going to be stopping buying and just collecting that mean dividend of about 10%. Next stock, it is VICI Group. So what VICI Group is they are a Las Vegas property real estate group that owns many big casinos out there, and they also own a couple golf courses. The thing I like about VICI Group is that it gets you into different exposure than you really could get otherwise. You kind of get the safe dividend of about a 5.51% dividend quarterly, or not that's divided by 4 would be quarterly, sorry. So they have that great going for them. But then you also get the growth of Las Vegas and the Strip growing and being more profitable. They're going to be able to milk more money out of these big casinos that people are just going there and spending money. And I think that over time, it's just going to get bigger and bigger and bigger. and they're going to be the person right there. They're going to be buying the land. They're going to be working with these casinos if they want to get a new, bigger casino or something. They're also having Las Vegas. They're having track days. They don't directly benefit from more people spending more money in the area, but they benefit when people want to build more buildings there and they own the land, or they want to lease more buildings, or they're just going to be able to charge a higher cap rate next time they sign the lease with them. They are not beat down as much. They're only down 10% on the year, but they don't have any underlying problems like the other two that we've talked about. So I'd say this is probably the safest with that. So then our last one, which is the blue chip of the 4. So this is down 32.1%. 1 second. Sorry. So it's down a hefty amount this year. My average cost is $112, and I am down a bit. But this is, as you can see, a hefty investment for me. It's 22 shares, but it only pays a 4.92. I say only, but that is a hefty yield. This historically only pays about a 2 to 3% yield. So I'm getting all these at a very good discount right now. And once their prices go back up, like I think they should, their yield will be down more, but I will still be getting this high yield because it's based off your average cost. If you guys have any questions about that, let me know, and I can try to explain anything if you guys don't understand some stuff. But so what this company does is it's a health science building's offices. But what a health science building is, like laboratories and stuff like that. So they have Pfizer and some of the other bigger pharmaceutical companies, and these are also Class A buildings. So they have some office buildings specifically and stuff like that. They have had a very good occupancy level, and they have had no struggles, but they kind of got lumped in with that office REITs sector, which has been destroyed, and some of it should be kind of destroyed, honestly. Looking at like some of the earnings and stuff like that, they're kind of don't look good, some of them. But that's not Alexandria Real Estate Group. They are a blue chip real estate group. They have came out and said, this is not affecting us. This is not going to be as bad as what you guys are expecting. So I'm loading up, and I have bought in both this main account and also my Roth IRA. But that is the 4 real estate companies that I would recommend just to get a starting position. They all have a high yield, so you're going to be bringing in that nice cash flow, but also a lot of them have great price appreciation kind of built into them once these REITs the interest rates come down. Alexandria Real Estate Group, $160 before interest rates were so high. SLG, $80 before they were too high. And they also might have the benefit of getting to pre-COVID levels even once the online jobs stop as much and they get more focused, or they actually have a plan how many places they're going to need and stuff like that. And CCI, they're going to recover by 2025 just because they're going to be able to restructure their contracts to recover what they are losing with this Sprint and T-Mobile acquisition merger. So thank you guys. This is JP Invests, and I will be just updating you guys on my portfolio. How's it going? I got a couple other moves that I think are pretty safe, but also I think they're going to have a pretty good return going into this rocky 2024. So I'm looking forward to making some more videos in the future. But this has been JP Invest. Have a great day. Make sure to subscribe and like. Thank you.